This episode of Masters of the Market is proudly brought to you by AIA Health Insurance with AIA Vitality, cover that protects and rewards. To find out more, call 133 AIA or visit aiahealth.com.au today.
Look, to buy when there's blood in the streets, lift up, check under the carpet. Many try but few become master of the market.
Well, Barry Carp, what a great honour to get you on Chris Judd's Masters of the Market. I've been pestering you for a while, but wrapped you coming on. And I thought maybe you could just start by giving us an outline of River Capital, and then we'll start to explore how you found yourself where you are today.
Well, it's a pleasure to be here, Chris, and thanks for having me. It's a long journey, 25 years this year, but I was a corporate lawyer, practicing in Melbourne, then Chicago, and I had investment bankers calling me to ask for documentation at their holiday homes on the weekend while I was working all night, and I thought, well, that's where I need to be. I need to be in the in the investment banking. They're obviously doing it better than the lawyers, so I came back to Australia and worked with Macquarie Bank, some terrific people, including Shamara, who's now running the bank, but Alistair Lucas, Simon McKeon, my current chairman, Jim Craig. So, in fact, we started on the same day at Macquarie. So that was in their Melbourne corporate advisory business. It was in the mid-90s, and boy, it was a different organisation to what it is today. I tell a story that I think I was offered shares. They weren't publicly traded at the time, but they were on a grey market at NTA of about $1.50, and
Wow.
And I made what is still probably my worst investment decision by saying, no, I don't want to have all my eggs in the Macquarie basket. So I said no to these shares at $1.50. Of course, they're $140 today, so that would have been a good start to my investment career. But I think, Chris, coming back to your question, it's about passion, and life is about following your passion. And as much as I enjoyed working with some great people, that wasn't my passion. And for whatever reason, my DNA, my excitement was about business and how business worked, and understanding revenue and profit, and meeting people and talking to them about their business. And even to this day, I don't know where that came from. Perhaps it's grandparents or great-grandparents, but something in my DNA excited me about business. And so really at the age of 29, 30, I made the judgment that that's where I wanted to spend my life. And River Capital was born, very creative start, working in River Street, South Yarra, and I thought, what am I going to call this? With the support of a handful of family and friends, in terms of very small investment, we got started, and it really did start with meeting with companies, and my focus at that time was very much small, mid-sized companies, and it was an amazing start to the journey, going from Macquarie Bank and a big law firm before that, to sitting in an office on my own effectively, and making this gigantic leap. But I look back on it now, some 25 years, nearly 25 years later, and it really is a lesson on following your passion.
So it's easy in hindsight to see the success of River Capital and for people to say, oh, it was always going to pan out like that. But when you're a 29 or 30-year-old, you would have had no idea how the future was going to pan out. What were some of the things you were feeling when you decided to make that leap? And what do you think it was that gave you the confidence to finally commit to leaving a much safer position at Macquarie to starting up your own shop?
It was safer, but I wasn't more comfortable in the safety, which is interesting. And I think there is an element of our human condition, which is sort of driving us to growth and driving us to perhaps do more and put ourselves out there and grow. And I think so, even though it was safe at in the big law firm and at Macquarie Bank, I wasn't comfortable. So, and it wasn't until I started actually following my passion and actually, and it is trite to say it, but you do feel the comfort that comes with doing something that you enjoy doing. And I had, incredible uncertainty, but more, there was an element of loneliness, as strange as it might be. You do get quite used to a big organisation and, chatting to people regularly and just have. So I think almost the overriding feeling at that time was excitement, but there was a loneliness in that I was on my own, and it wasn't. It wasn't an easy environment to start off with.
And even, I'm assuming the capital you got given during those early years to invest, if you're like most people, it's probably from people you knew pretty well, perhaps some family or even friends. That's a tricky one, isn't it? It's a lot of added pressure. It's one thing to lose your own money. It's another thing to lose, family's money. How did you navigate those sort of emotions in the early days?
It's still, Chris, it's still the biggest challenge. So, and I don't think I've gotten to the end of working out how to navigate that. So even today, we've probably got 700 or 800 investors into our main growth fund, and we've got a few other funds that have emerged out of that period. But nonetheless, in our main growth fund, if I don't know all the investors on a first name basis, it's pretty close. And a very significant number of them are still family and friends. And so I still haven't worked out how to wear the slings and arrows of average performance and bad decision. And it's really public and it's really hard. So, alongside people's health, managing their financial affairs and getting that right is right up there. And so, it's a great point, because I don't know whether you want to be, whether it could have been or should be a different personality in a sense that doesn't dwell as much on those things. But you really do wear your heart on your sleeve when you've got investors that you're close to, and it does make it harder. But I think it also makes the relationships and makes the business a much more personable and much more significant affair. So I wouldn't change it for the world, but it is something that I'm still learning to navigate.
I'd find it. I don't know if paralyzing is the right word. I don't think my decision making would be as good if I was managing other people's money. But then I speak to some other investors and fund managers, and they say having other people's capital to allocate creates a discipline that they may not find if they didn't have it.
Yeah.
Where do you sit on that? Do you think your decisions are better for having that pressure, or do you find yourself taking perhaps less risk or less adventurous opportunities than you would if you didn't have that money behind you?
Yeah, it's interesting because we just did an exercise just recently of testing our asset allocation over the last 10 years. And what I mean by asset allocation is because so much of our investment fund is our own capital, say, probably 30 to 40% of the capital in our main growth fund is family and staff. I think what we've done as a result of that is we have tended to make asset allocation decisions in relation to cash. And so there have been times over that journey where we have held significant levels of cash because it has probably reflected the significant investment that we have in the fund as a family. Mm. Has that served us well? Interestingly, the back testing that we did, the answer is no. So the answer to your question is it probably hasn't served us well. Had we our stock investment and our stock decisions have been terrific, but the asset allocation in terms of the cash weighting along that journey actually hasn't served us. So you would expect us to have more cash and lots of cash when markets have run harder and therefore liquidating and taking advantage of sort of building cash reserves there, and similarly investing that cash when markets are sold off and taking advantage of opportunity. But the reality and the human nature of those decisions has been different. And we've probably detracted a little from performance because of the conservative nature of the asset allocation decisions that emerged from us having such a significant investment in the fund. So we've had to make sure that we bring and overlay a portfolio discipline like the one you talked about with institutional investors that actually says, okay, let's make sure that we're not detracting from performance by getting that asset allocation, by putting too much time into that asset allocation decision.
And is there an ability for institutional investors, I speak, some family offices say they like the funds they're in to be pretty close to fully invested because they want to decide what they have cash-wise, what they have invested, and if they give money to a fund, that in their mind is capital that's allocated to the stock market. They've got their own cash holdings to allocate when prices drop, so to speak. Yep. Do you offer mandates for institutions where they can piggyback on the fund's decisions, but they're effectively fully invested?
Yeah. So we've got, one large, sort of high net worth institution that has pursued that with us. And we've done that because we do think it brings a host of discipline to our investment processes in the main fund. And so we do offer that capability. But one of the things we have prided ourselves for 25 years on is that we were all invested in the one entity, the one legal unit trust, and that still remains the case outside of this one institutional investor that does have a managed account and is able to make that cash allocation decision. Every other of those 700 investors are with us, with the family, in the one unit trust. And so they have had the benefit of the investment decisions that we've made in that fund, and also, if you like, the detriment of that over allocation to cash at different times. But on balance, it's been a terrific journey for all of our investors over that period of time. And there is something powerful about saying, we're all in the one investment vehicle together, and we all effectively get the benefit and the detriment of that. And so we've been very constant with that over the journey.
And speaking to people in the industry, I was speaking to a CEO about you, and he was praising your attention to detail, and he said you're a meticulous note taker, and that even he would talk to you and you would bring up something from 5 years ago and say, well, no, that's not what you said you were going to do back then. Is that a natural character trait that you've had, or is it something that's been developed over your journey as an investor, or is it a little bit of both?
Yeah, I'm really proud of the fact that we've got a number of investors, many investors actually, that have been CEOs of companies that we have invested in and interacted with. So, one of the joys is that relationship that you can build and develop with CEOs. It's interesting. I think one of the key traits that you need, in my view, and I look for in people that we work with, is that curiosity and the humility. And the curiosity, I often say that, in my view, every company is like reading a novel. And some are really interesting novels and some are really boring. But nonetheless, to me, and the guys in the team would say, they've heard countless times me asking them, tell me the story. Because I really do believe that every business has a story. It has a start, a middle, an end. And you really don't do justice to the meeting that you're having with the management of that business unless you understand the story, because there's so much in the history that informs the present and the future. So I used to have a thing, and I still do actually, and I encourage our guys and girls on this, is that whenever I come out of a meeting, it's the first thing I do is to note down my instincts, my emotions. It's not this is not a transcript of the meeting and how many widgets were sold and what the cost of goods sold is and the profit. This is, boy, I'd like to be invested with him. What a great guy. What a journey. I think he's amazing. And this is a journey I want to be on. Just 10 minutes, I would sit in my car, literally outside the meeting. As I'd come out, I'd sit in my car, and before I'd drive anywhere, I'd scribble down that. And that was the genesis of the note-taking. And it's so rewarding because because it's so hard to capture the emotion and the instinctive feel, even 3 days later, because so much is going on in our lives. But 5 or 10 minutes after, it's all there. And so when I would go back 5 years later for a meeting with that company, it's so powerful. I mean, I can see exactly how I felt in the notes that I took immediately after meeting with them. It doesn't always result in the best investment decisions, but it certainly helped.
And I guess it's something that the algos can't do, isn't it? Investors are always talking about edge, that idea around, feelings and nuance and reading someone's body language when you're speaking to them. That's something that the algos, at least for the time being, can't do.
They're getting better. They're getting better. I'm actually just reading Bezonomics. Just finishing the book on another book on Amazon, and I tell you, as you're reading that, you marvel at where the AI is going. Yeah. And I do for a moment think all of us need to be incredibly aware of how quickly that is catching up. But for the moment, you're right. I still think there's some real value, and I'm still saying to the team all the time, there's real value in that emotional response that you have, because business is a lot about instinct and a lot about gut feel and a lot about doing things on instinct. And if you get too bogged down in the financial model and trying to make the investment thesis work, I often say, you've got to be excited about this. You don't need to force yourself into investing in something. And so there's still a lot of emotion and instinct in that, I think.
And so we talked about your character traits of meticulous note-taking, really organised. When you're looking to hire staff, do you want staff that have those same character traits so they fit into the company culture? Or are you looking for staff with different character traits so that they complement other areas of the business? How do you sort of tackle that from a culture perspective?
Yeah, that's a great way of putting it, because do you just hire mini-me's, or do you look for people that bring different skills? And there's certainly no point in hiring mini-me's, as comforting as that might be, because they do things the same way or they're willing to do things the same way. No, you've got to bring people into the organisation that fill the weaknesses that you've got. And I'm really proud, actually, as I look on our journey and I see, guys that and girls that did their early years with River over that 25-year journey and now doing other things, in their own businesses and creating their own organisations. I'm really proud of that start that we've given them. So there's an element of the DNA that we have that I think is very important for our people to have, and that's the curiosity, that's the humility, it's the note taking, it's doing those things. But there's lots of stuff that you want people to bring of their own personalities beyond that, and we've got deep thinkers, we've got instinctive thinkers, we've got curious and humble people, but we've also got confident and assured people. So definitely don't want mini-me's. And I think there is a journey to be had in this, or in funds management, like in any business, in leadership, and it's something that I'm definitely still working on, and is, there's no easy code that helps you, working with people and bringing those people up to to their potential. It's one of the great challenges.
And also, I guess when at your stage, you're now got two different jobs in a way. You're an investor,
Yeah.
and then you're managing a team and developing staff underneath you. How do you sort of view those or split those two roles? And which one do you see as keeping more of your focus in your day-to-day today?
Yeah, it's funny because when people would ask me what I do or how I would define myself on a business card, it really is an analyst. For the first 10 or 15 years, that's really what you're doing. And you'd be well aware. I mean, the time that you spend actually, just making assessments and analysing businesses, that's at its core. But then all of a sudden, the human condition being what it is, you want to grow, you want to do more things, and you bring people in, and there is something nice about developing people in a team. And I think fund managers perhaps make some of the worst business leaders in that sense, because typically the best fund managers are guys and girls that are really very happy in their own company, just not being too perturbed about the noise and the and everything else that's going on, but just focused on their own thing. Well, to be a leader of a business, you really need to be comfortable dealing with your people and engaging on a regular basis and providing feedback and all of that. You can't just sit in the office with the door closed and do your analysis and talk to companies. So I found that the biggest challenge. In my wife Susie, who's very involved in the business, has been a really good balance there in helping on some of those softer skills, in helping on the people skills, in helping to grow the business. So she might not necessarily be involved on the, do we buy this or do we sell that? But making sure that we're surrounding ourselves with the right people and bringing the right culture and all of those things. She's been instrumental in that. So it's not a skill that I don't think is natural for most fund managers, and they do end up having to hire. You see a lot of guys hiring a CEO or a COO or whatever to deal with the people issues. I've just surrounded myself with really good people, including Susie, to help really get some balance to the staff and to provide a pathway and a journey that's exciting for your team, because that's ultimately what we all want, to go to work and have that passion and be challenged day to day.
And so you mentioned the idea of understanding the story of a company, but maybe just digging a little bit deeper into your investment process. So I've been to your office before and we've had a chat, and I've seen there's just whiteboards everywhere, enormous whiteboards, and a lot of relative comparisons of companies in the same sector. Do you start with different sectors that you like and then seek out the best value companies in that sector, or maybe talk us through your investment framework from start to finish? Yeah,
we do. We do start with sectors that we like, because I'm attracted to simplicity. I'm attracted to past patterns and behaviours. And so whilst we all want to grow and learn new things, there is an attraction to businesses. In our case, it might be quick service restaurant businesses, and think of Domino's and KFC. Why? Because average weekly sales, margins are predictable. I can map out patterns over a long period of time, and you can see where those patterns are out of whack. Developed software businesses, data centers. We started investing in international data centers actually originally, and in fact, before Next-DC was even a listed company here in Australia. But so retail, branded wholesale. Why? Because many of our investors had retail backgrounds and branded wholesale business backgrounds, and we could therefore leverage off their skills. I could take an investor to a meeting with a company. Nothing more powerful than going along to a meeting with a company with someone in the industry that actually knows the questions to ask. So our investment process was very much based around that first meeting with a company in a sector that we had developed a little bit of expertise or knowledge about, and making sure that we asked the right questions, had the right people in the room to ask the right questions. Don't waste people's time. Don't waste management's time. And then come back and start to map it out on a whiteboard. Start to think about, the different business choices you have in that sector. Start to compare and contrast. But ultimately, when we boil it all down, we're looking for 22. I always talk about a football team in terms of the first 22. Do we have 22? What are our 22 best ideas and why? And that'll form the basis of our team. There might be 23 or 24. There shouldn't be 30. 22, there'll be lots of reserves looking for a spot in the team. And then you say, okay, what will the 22 look like? Well, in our case, they'll probably have 4 different styles of business. They'll have what we call our infrastructure style business, predictable cash flows. Think Sydney airports, think Auckland, think those sorts of businesses. Then you'll have your platform cash cows, your stars. They're the leaders in their fields. That's the realestate.coms, the Seeks, the Fisher and Paykel Healthcares. They're the dominant players. They're your best players in the team. They're also the most expensive. And so you can start to formulate it. We've got a third category, which are our land grab businesses. Think of business like Afterpay. That's your recruit that could be anything. Yeah. And finally, you've got, in our case, what we call our cyclical businesses, and they're capable of being great, but they can really disappoint as well. And so they're your erratic performer. So even in our 22, we're looking at it like in a sense, like a starting football team, and you'll have a mix in those 4 categories of performers and what you're expecting from them. Bring it all back to an investment thesis, bring it all back to a financial model of what you expect over the next 5 years, and make sure you're monitoring their performance religiously against that investment thesis. And that's what we try to do with our football team.
I like it. And you've got a really heavy focus on return on invested capital. People love putting investors in a box, and probably full stop, don't they? It's not just investors. They love it if you can neatly fit people in a box. So perhaps we could put you in a value at a reasonable price box, preferring not to have to do that. But put that aside, is there a room for an investor to change their style depending on what the market opportunities are giving them? Or do you think if your strength is analyse and investing in companies that have high returns on invested capital and that's where your skill set lies, you should stick to your knitting?
I think it comes back to what you're passionate about and what you're really excited about. I don't think you certainly can't flip-flop across strategies. You can't, in my view, and perhaps there are examples of some that have, but in our organisation, I think you have to anchor to something as an organisation, whether it's a label, whether it's a DNA, whether it's a way of going about it. I don't think for us it's a label. I think it's more a DNA and a way of going about things. So that means that you might have in the one portfolio, Afterpay and you might have Sydney Airport. 2 more different businesses you couldn't find. So I think from our perspective, I would like to think that we're very true to our DNA, to the sort of process that I outlined, to formulating a team of businesses that have different qualities and different characteristics deliberately, because you wouldn't want a team of Afterpays because that could end badly, nor would you want a team of Sydney Airports. So I think there is scope for mixing and matching. In the same way, in an AFL team, you've got a very clear mix of qualities of players. I don't think that though you can actually flip-flop according to what the market's doing. It's very hard. We were talking about it earlier. It's very hard not to get drawn to the green or to the red. And momentum can be such a dangerous thing in terms of investing, getting carried away with the momentum. And one of the things that we're always trying to be true to is that, you have to sell a business when there are lots of buyers, and you have to buy a business when there are lots of sellers. And that is almost the hardest thing to do. because to sell a business when there are lots of buyers means you're selling it when there's all that green. And similarly, to buy a business when there are a lot of sellers, you've got to buy it when there's all that red. And if you don't follow that, then, and we've seen it, we've been guilty of it so many times, that if you're trying to sell a business when everyone else is trying to sell it, well, we know how that ends. And similarly, if you're trying to buy a business when everyone else is buying it, you're paying a big price for it. So it's you do need to find an anchor in the way you do things.
One of the challenges when you're buying, when a lot of people are wanting to sell, is you're potentially early and you can have a cost in your monthly performance or your 3 monthly performance, even though the longer term outcome may be exactly how you want. How do you manage that as a fund manager, where you've got potential redemptions from monthly performance or quarterly performance? How do you manage the need to keep monthly performance where it needs to be versus longer term objectives?
I think you have to align your business with your investors. Yeah. I think it does come back to that, and we've grappled with this along the way, as many do, particularly if you're running an open-ended fund providing liquidity as we do, that you need to make sure that you are working with investors that are aligned to your way of thinking, and can absorb the shocks of sort of monthly volatility. But you still clearly need to demonstrate that you can generate, decent long-term performance, and so I think it does come back to that alignment of investors, because you could, whilst all of our investors will say they're long-term focused, and I believe that, there are many that take comfort in the monthly liquidity that the fund offers and the ability to come in and out. So just to close the fund and turn it into, if you like, a private equity style fund would I think make many investors, notwithstanding their long-term investment horizons, uncomfortable. So we do strike a balance between providing liquidity but ensuring that our investors are long-term focused. And the way we do that, to give you an example, is I had an investor call me the other day, or a potential investor call me the other day, to say that they had just sold their house. They weren't going to be in the market for a year or two. They were just going to, sit on on that cash for a year or two. But could they put the money into the growth fund for a year or two with a view to buying the house? And I said, absolutely not. That makes no sense, because you're taking a punt on where the market's going to be in a year or two. Notwithstanding my views on buying and selling property in different markets and all of that, I wasn't going to get into that. But just understanding that for that investor, they really were looking to have that cash to buy a property in a year or two. It's not appropriate to put them into an equity fund where that volatility of capital pricing is so prevalent. So you do have to align your investors to what you're providing, and that means that for some people you're not right. Your mandate is not appropriate. That's fine. There are so many different mandates out there and so many different, investment opportunities. You just got to match them with your investors' mandate.
And speaking to someone else who's worked with you, they mentioned one of the things they admire about you is that when you do make a mistake, the ability to just do the work, acknowledge it's a mistake, cut it, and move on. Versus, I think it's more a trap that retail investors get into, where they end up doubling down and looking for confirmation bias to prove that it's not a mistake. Do you agree that that's something you've developed? And is that a natural skill or a learned one?
I think it's actually, I find it easier, almost perversely, I find it easier to cut those bad decisions than to hold on to them, because it becomes, and I know what you mean, there's always the temptation to put something in the bottom drawer in inverted commas and it'll come back, not worry about it. But that capital is available to you and to your investors to invest in something that you're genuinely excited about and that you've gotten right. And so having that investment thesis, and it doesn't need to be a complicated document. I mean, I often would say to our guys, I want to be able to explain at the time to my 9-year-old son, who's now 18, but I want to explain to my 9-year-old son why we're investing in this. Can you explain it in those sort of terms? Because if you can't, then perhaps you don't understand it. I've always been a believer that you need to be able to explain something so that a 9-year-old can understand it. That demonstrates that you can understand it. And so our investment theses aren't long and complicated. But why do you own it? What are you expecting? What profit growth are you factoring in? And then put that into, it doesn't have to be a sophisticated financial model, but put that into a model. Now, if after 6 months you see the company report and they present their accounts and you're looking at it and it bears no relation to what your investment thesis was, then the best thing to do is move on and say, I didn't understand this. This is totally different to what I anticipated, or we just got it wrong, whatever the reason. But move on and find something that that you've got a better understanding of and that you're more closely aligned to. Now, that's different, of course, to actually, a company missing your forecast by 5% or 10% or whatever the number is, but the long-term expectations being very much consistent with your thesis. So, the cutting it straight away is where you look at the result and you go, wow, this is so different to what we'd anticipated that we just got it wrong. Let's move on. And there's almost a little bit of a liberation in feeling, because you want there to be competition for spots in your best team. And when you're constructing a portfolio, it is a blend. You'll get some wrong. You need to get more right than you get wrong, but it is a blend, and you need to make sure that you have stocks pushing for positions in your best team. And therefore there'll always be stocks, and sometimes they're not even the worst performing. You just don't necessarily have the aspirations for that business over the medium term, or they come out. And that can be even harder than selling a position you've got wrong, is selling a position that's actually, it's okay, but it's just not going to deliver you the performance that your best team needs to deliver you.
It's brilliant. Well, I could cheer you off all day, but I thought we'd finish with 3 questions, if you don't mind. So, what was your first ever investment?
I've got to tell you, Chris, we used to sit around in the Monash University Law Library underneath there, smoking cigarettes and drinking coffee and punting penny dreadful stocks in the 1980s. And what a brilliant lesson for a young investor, because in those days there was no T+2, it was T plus about 27.
Yeah, that's right. I heard that.
So we would buy a stock and we would sell it, and we'd be done before we even had to think about settling it. And going into the 1987 crash, friends and I, we had a portfolio of penny dreadfuls. They all went, and what a great lesson, they all went under. In fact, sadly, I had friends even at 19, 20, 21 that were going through bankruptcy proceedings. But what a great lesson about what can happen. So I can't tell you the exact name of that penny dreadful, but there was a thematic that's perhaps maybe much more conservative going forward.
Sounds a lot like my life now, just without the cigarettes and university, to be honest.
There you go.
What advice would you have to your 18-year-old self?
That's a great question. But what
investment advice, preferably. It can be life advice if you'd prefer.
No. I think investment advice for me is I still think making things more simple, less complex, being curious and humble. So I've said those words a few times, but it's amazing how much the relationship with a CEO is improved by recognizing at the outset of that meeting that you don't know anything about their business and they know a lot more than you. And it's amazing how many 18, 19, 21-year-olds will go into a meeting first and foremost, and we've all been guilty of it at that age, being full of hubris and confidence because that's where we are in life, and not recognizing the expertise of the person on the other side of the table. So listening, ask questions. There's never a silly question. I wish I had have told myself that at 18. Don't be afraid to ask questions. There's no such thing as a silly question. And in fact, most of the silly questions that you hear asked are the ones that you wanted to ask but didn't have the courage to. So I'd certainly be telling myself that at 18, 19, 20.
And what are the most common mistakes you see retail investors make versus professional investors?
I think it's that buy high, sell low that we talked about earlier. I think it's that that momentum, driven strategy. But I've got to say, I also know many retail investors, many smaller investors, who are as good at this as people that we would describe as sophisticated investors. So I often, I know a lot of people go to that tag of, go with a fund manager, go with an institutional investor or a sophisticated investor over a retail one. But in our investor base, we've got some smart retail investors, and there's so much that I learn from our own investor base, and so I think sometimes we're probably a little too quick as professionals to characterize retail investors as buy high, sell low, which is a popular way of describing it. But we've got a lot in our investor base that could and do show us a thing or two at times.
Barry, it's been brilliant, mate. Like I said, I really appreciate you coming on. I've loved the chat. I've learned a lot, and thanks very much for giving me your time.
Thanks, Chris. Really appreciate it. Take care.
Thanks, mate. For more info on today's partner, AIA Health Insurance, visit aiahealth.com.au or call 133 AIA today.
If you're enjoying Masters of the Market, make sure you subscribe to Chris Judd Invest.